This is a stock analysis update for TotalEnergies. TotalEnergies are the world's sixth largest oil company. They're French, but they're also listed on the FTSE. Before I start this video, please remember that I do these videos just for fun, as a hobby, and always speak to a qualified financial advisor before making any investment decision. TotalEnergies broke the world record with 47 billion of free cash flow for an oil company in 2022. And they look like having an amazing free cash flow this year, having achieved 27 billion just up to the third quarter of this year. They pay a 5% dividend and are currently engaging on 2 billion a quarter of share buybacks. The reason why they've beaten all the other oil companies in terms of free cash flow is because they're very focused on refining in Europe. Margins are extremely good since they can no longer import their refined products from Russia. And they're also the number one liquid natural gas exporter from the US, where gas is cheap, and the number one regasifier into the EU, where gas is expensive. So this company is very well set up for the current high refining margins and high price of gas in Europe. They have a consistent strategy that they've been sticking to for quite a few years now. And in this strategy, 40% of their free cash flow is returned to shareholders. And that's done in the form of roughly half and half dividends and share buybacks. 40% is used for deleveraging, i.e., paying off debt, and 40% is used for reinvesting in the business. And this reinvestment is done a third maintaining their oil business, a third maintaining the gas business, but then also with some expansion into their liquefied natural gas, and a third is going into renewables. Looking at their 2023 profits, you can see 42% come from the exploration and production business segment, 21% from refining and chemicals, 6% from marketing and services, 24% from their integrated gas, which is mostly their LNG, and 7% from renewables and power. They actually have gas-fired power stations, which obviously are very profitable at the moment in Europe, and that actually makes up most of the profits in that segment. So one thing that's really impressed me with TotalEnergies is that while the other stocks you can invest in the UK, particularly Shell and BP, have been flip-flopping all over the place for many years now. One minute they're ditching oil, turning themselves into renewables companies, and then the next year they're switching off their renewables investments. They're just all over the place. In contrast to that, TotalEnergies actually began their strategy in 2017. And here I've got like a clip from their 2017 annual report, where they're quite clear that according to the IEA, there's going to be a big growth of demand for electricity and natural gas. And so they plan to focus on LNG and focus on selling electricity using gas or renewables. And they've really have stuck to their strategy. And then this is the most recent iteration. And interestingly, in their 2022 annual report, they're quite clear that they're very confident that even with $50 a barrel oil and $8 gas prices, which are very low hurdles to get over actually, even at those low prices, they're very confident that they can achieve the investment of 14 to 18 billion in the coming years up to 2030, while still paying a very nice dividend. And they've stuck to this strategy, and it's left them in a very strong position, whilst the other oil majors have been dithering and flip-flopping about. We've got here their longer term vision, where in terms of their energy production, they maintain, rather than cutting, they maintain the amount of oil they produce. They actually increase the LNG they produce so that overall they're supplying more gas to customers. And then there's a 20% boost to their electricity, most of which will be in the future from renewables. So then when we come onto their energy sales, we see how in the future they're going to be selling electricity in Europe, where it will be very expensive because of the government's energy policies. And they'll be selling LNG in Europe, which, with that gas being very valuable, again, because of the European energy policies. So they have this strategy that, is very clear cut. And given recent events in politics and in the world, they're actually in the prime position to do very well. And it's great that this strategy they've had in place going all the way back to 2017. So looking at their revenues by business segment, and 15% of their revenues come from oil and gas production and transport. And that actually then translates to 42% of their profits. Now, 86% of those sales are into segments. That's selling to their own oil refineries. Now, that oil then gets refined in their oil refineries and also turned into petrochemicals. And the refining and chemicals segment is 44% of their revenues. And that also does include biofuels and trading. They do a lot of trading of crude and refined oil, in fact, more than they actually produce themselves. And this is something that they do, which a lot of the oil majors do less of. But it does then help with increasing their revenues in this segment. And so their refining and chemicals segment is a quite healthy 21% of their overall profits. Their marketing and services, this is their actual petrol stations, which will have the EV charging in them. And this, however, is only 6% of their overall profits. And then they have what they call their integrated power. And so this is their, I think that biogas and hydrogen is in there, but very kind of not that significant at the moment. But they have their gas power stations, which obviously produce electricity and a lot of money in Europe. And then they're adding to that their renewables, and then this is currently 7% of their profits. What really differentiates TotalEnergies from Shell or BP is just how perfectly they're positioned for the situation in Europe. They've actually got gas power stations in Europe which are going, which generate a lot of money. That's very profitable, and because the price of electricity is only going to long term go up in Europe because of their energy policies, and then also Europe's now very dependent on LNG, and TotalEnergies are very focused on LNG, and they're the number one exporter of LNG from America, where gas is cheap, and the number one importer into Europe, where gas is expensive. So they really are perfectly positioned, and that's then reflected in their really good profit contributions there from their integrated gas segment. So this shows how they produce 1.5 million barrels per day of crude oil themselves, and much of that they refine themselves to then go to customers. But they do a lot of trading, a lot more than Shell, was the last one I looked at, and that does help beef up their refining and chemicals business segment. And looking at the oil price, we knew that 2022 was going to be a bumper year, and that really we want to compare with 2021, which was a kind of new normal year of slightly elevated oil prices. We're definitely in that mode of a kind of new normal, slightly higher oil prices compared with the history. And so we see that in the exploration production segment, they're doing very well with these new normal oil prices. In terms of integrated gas, of course, they're doing amazingly well, even at these, new normal. It's way above the baseline, and this is of course the fact where this is of course because the situation where now the price of gas is, of course, the price of gas has now equilibrated significantly above the long-term average. And so their business of being the number one importer into Europe is seeing them do really well in that business segment, and it's well elevated above the historic levels. The green line up here, that's the variable cost margin, which is how much money you make from refining in Europe. And as you can see, of course, we're not importing diesel and gasoline from Russia anymore. And as you can see, the variable cost margin is stayed at this very elevated price up here. And so this is why their refining and chemicals business segment is doing amazingly well. And then the marketing and services is just kind of baselined there. The renewables and power, that's actually a new business segment that used to be within the integrated gas, actually. Um, and that's obviously fairly minimal. So overall, we see here how TotalEnergies' position of being the number one exporter from the US and number one importer into Europe of LNG, and as well the fact that they actually have gas power stations in Europe where they're able to command good high electricity prices, as well as having refineries in Europe, really has put them in this very, very healthy position. If we look at these different commodities, we see that the price of oil is staying at a elevated high. Refining margins are way higher than they've been historically. Electricity prices in Europe are way higher than they have been historically, and the LNG price and and gas prices are remaining at these elevated prices. So this strategy that TotalEnergies have been working on for quite a few years now, it really is massively paying out, and this does explain their record-breaking free cash flows and how they're able to return so much to shareholders whilst being able to invest significantly, reinforcing what is clearly a winning strategy for TotalEnergies and one which I think makes them better than Shell or BP. So if you go to my last video I did, I went into a lot more detail perhaps of some of the history, but like I said before, all that strategy they're doing so well from now, that all began in 2017. That strategy was maintaining oil and gas whilst focusing on the sale of gas and electricity, generating more electricity from gas and renewables with a big focus on LNG. So I won't go into detail too much, but a couple of things to point out was was obviously the very unfortunate invasion of Ukraine by Russia that led to higher refining costs and higher natural gas costs, which has been very favourable for TotalEnergies in Europe. In 2022, one of their development projects came up with a really large oil discovery in Namibia. It was reported at 3 billion when I put this in, but apparently some speculators have been talking about a 10 billion discovery, and the at the latest investor call, though, the CEO quite clearly said that wasn't true. He was a bit coy about how much oil they think they have found, but his words were it's at least 1 or 2 billion. So even if we're to be very pessimistic and say it was only 1 billion, that's a very significant discovery because their oil reserves at the moment are currently about 5 billion. So obviously, 1 billion is going to really keep them going for quite a while. And so that is a very significant discovery that could actually be even larger than we realize now. And so that is a very important news story. So the dividend yield's currently about 5%. Actually, because I bought them here, I'm enjoying a 7% dividend yield off this company. So to look into their integrated LNG, and you can see here how since when their strategy started, they really have been boosting their LNG sales just right for the perfect moment when in 2021, when in 2022 we found ourselves importing a lot of LNG into Europe. They're the third largest LNG player in the world and the number one exporter from the US, number one importer into Europe. They're liquefying that natural gas in all kinds of places of the world where it's not so needed and it's really cheap. And then they're regasifying it in Europe. And this is, working very well for TotalEnergies. Here's Shell in contrast. And you see that Shell are gasifying their LNG where gas is the cheapest in America. So, yep, TotalEnergies really have got the best logistical situation of when it comes to LNG. Here's the same, but one of their own graphics where you see the same thing. Here's a breakdown of their liquefaction assets that I put together. And then here's where they do their regasification. And as I said, it's all in Europe. It's mostly in France, but there's also some in the UK and a tiny amount in the Belgium and Netherlands. All of these places, though, are very hungry for natural gas. And here's a summary of their recent deals in LNG. So their integrated power. Now, in the last video I did, I think I downplayed a bit their renewables. A third of the money they're investing into the business every year, they're investing into renewables. And you can see here how they're clearly way ahead of Shell and BP, who've recently actually been winding back on their renewables pledges. And they are going full throttle for 100 gigawatts installed by 2030. It's actually their ambition to be a top 5 renewables producer of electricity. And so you have to face it that TotalEnergies really are drinking the renewable energy Kool-Aid. And that's quite interesting because only this year, a lot of people have been pulling back on their investments in renewables because, particularly offshore wind, it seems to be turning out as a bit of a disaster zone. So it is a little bit concerning as a shareholder to see that TotalEnergies really have drunk the Kool-Aid on renewables and they're going to become a top 5 electricity producer. What I would say is if you're into renewables and you're into green energy, then actually the one company you should buy is TotalEnergies because one of the best renewables investments you could make actually in terms of the amount of renewable capacity they're building. As a skeptic of the profitability of renewable energy, the way I look at it is this is really a kind of unfortunate distraction when you're trying to assess TotalEnergies as a shareholder. The way I feel is that they're doing so well and they're just so pitch perfect with how they're set up to profit from the energy transition. And this, the data on that is very clear that they do have the money spare, which they can plow into renewables like they are. And, they are maintaining the oil and gas. But the money they're making from the rest of their business, they can take this gamble and it's not going to break them in half. But it's kind of a bit of a kind of unfortunate distraction for me. To be honest, I'm not really very happy about seeing them spend a third of their spare cash on renewables. That's something you've got to swallow if you invest in TotalEnergies. In terms of their electricity generation, you can see here how there's significant increases in their installed capacity of renewables versus gas power stations. And here we see their power generation. And actually, bear in mind this is the third quarter, so it will bip up a bit. But the gas power, it peaked a bit last year, and that was because in France they had problems with their nuclear reactors because of the water levels were too low. So they had to rely, in an emergency kind of thing, they had to rely on their gas power. So I think that's why there was a boom in 2022. So they're now settling down a bit, but it's still actually generally will be a higher trend once we've included the fourth quarter base compared with the earlier years. And then here we've got the renewables in green, which, as we can see, continually increases as they steadily build their capacity, and their capacity will be 100 gigawatts by 2030. Now, looking at their integrated power, it's actually two-thirds of it is solar at the moment. Construction and development. There's actually a lot going on in North America. In fact, North America more than anywhere else, actually. But there's quite a lot in India and a lot in the rest of Europe. I think generally, and I mean, here's the actual installed capacity. It is kind of good that a lot of it's solar rather than wind, and that's in hot countries. So building solar in India makes sense. So here's the news releases for integrated power. One thing of note is they actually this year finished the Seagreen project, which is a 1 gigawatt offshore wind project in Scotland. So here's the website, and as you can see, it's a very impressive looking installation. Now, there's been lots of news stories though about other people's wind farms breaking down and being a total disaster, particularly with Siemens getting into trouble and Ørsted. So we'll see. We'll see what what's different about Seagreen, but still, it's a very significant project at least, and it's sort of close to home to me. So it's something of interest. And it's good to see that of the solar developments that we saw, 3 gigawatts of that is in Spain, and obviously solar does make sense in Spain. So exploration and production, and that's oil and gas exploration, production, and transport. And apparently they have a $25 break-even price for their oil, which is much cheaper than a lot of their rivals. We can see the 50-50 split roughly of their hydrocarbon reserves. And here we see their reserves. And actually, you notice how there's a dip in the gas reserves, and that's because they had to write off their Russian businesses in 2023. And you see again a drop in their production of gas for the same reason. But apart from that kind of one off, they are keeping their production fairly steady and their reserves fairly steady. You see here the breakdown of where they produce and where their reserves are. So here you see where they get their oil from. It's pretty much everywhere over the world. But importantly, most of their refining is in Europe. So again, this differentiates them from their UK listed rivals. Where they're refining is where you get some really, really good refining margins at the moment. So here we see their operating costs are way below all of their peers. And really the reason for that is whereas BP and Shell tend to be a bit squeaky clean and only operate in territories where they They think that it's absolutely no risk at all of any war or anything. TotalEnergies do tend to do business with anyone, and they'll just do business with people all over. I mean, you've got Iraq, Libya, they'll go anywhere. And currently, Nigeria, Iraq, and Kazakhstan, I think, look kind of a little bit risky. And then, of course, they've been doing stuff in Mozambique, Russia, Venezuela, and some of these assets are now completely written off. But what seems to happen is they take that risk, and there is a certain level of attrition of their assets because of that. But with this approach, with what's left after the attrition, they wind up with really cheap operating costs, and so they outcompete their kind of scaredy cat rivals of BP and Shell with that strategy. And that again, I'm sure helps contribute to how they are world leading in terms of their free cash flow. So here's their proved, developed, and undeveloped reserves around the world. And from that, their discounted future net cash flows for their own subsidiaries and then for equity partnerships. And what this tells me is unfortunately, the numbers are updated yearly based on whatever the price of oil is that year. But that does very roughly then give us a value for $41 oil, $69 oil, and $101 oil. And so we see that the value of the oil they have in the ground is about 87 billion in terms of at $69 oil. So here's their news, and you see that compared with the other segments, there's a lot more red divestments, which I put in red with their exploration and production. And so, this is more of a maintaining, not growing. But what has happened though is they've had oil discovery in Namibia, which is apparently more than 1 or 2 billion barrels. And then they've also got this Suriname project, which they've started developing, and that's going to be 0.7 billion. So even this one, which is a fairly new development, that means that in terms of their oil reserves, they really have got, some good future growth there to keep them going according to their plan. And that's before we've got this recent extremely good discovery in Namibia. So although they've been very tightly budgeted in terms of the exploration budget, their team is actually very good at finding good oil prospects based on these tangible results we see. So that's like a positive extra bonus about this company. Another very important thing apart from this is that they sold, and in fact, these I should have, put red. These they actually sold their Sermont Canadian assets to ConocoPhillips for 3.3 billion, plus some other assets for 1.1 billion. And these were oil sands, so that's obviously higher costs and less environmentally friendly assets. So it was in their interest to sell those. I was a bit disappointed, by the way, that they had initially talked about paying that out as a big special dividend for everyone. In 2022, they paid us a €1 special dividend on top of the usual dividends. So I was hoping for the same, and I was very disappointed when they said that they were instead going to use that for stock buybacks instead. So, okay, refining and chemicals. So they have their oil refineries, particularly in Europe, and they sell petrochemicals as well. They also add biofuels and their oil and refined oil trading as well in this business segment. Now, you can see that their refining is kind of stabilizing, and their petrochemicals is dipping down. There's still a downwards trend. Here we see how great their refining and chemical earnings are. And you see here the variable cost margin sky high compared with what it was historically. Petrol and diesel prices are nice and high, and the price of natural gas seems to be equilibrating above the historic levels. So this is where their oil refineries are. Here's a breakdown of their refinery outputs. You can see actually what a tiny contribution the renewable stuff is, despite all the fanfare. Here's how they do this amazing renewable oil, biodiesel. That's where they get chip fat and whatever, turn it into aviation fuel. So yeah, that's all good. They're producing less petrochemicals, but producing more recycled petrochemicals. So you can sell that recycled plastics for a lot more than you can sell normal plastics for. So here's a breakdown of their crude oil sales and supply and product sales. So here we see how they actually sell 3.8 billion barrels per day, but only 1.3 billion of that is from their own production. They actually buy off other external people the other 2.5 billion. So that explains this graphic where you see they're buying oil from all kinds of people around the world to then sell, in addition to buying their own stuff, which they sell. So they're very much oil traders. It's a very important part of their business that you don't have so much with Shell, for example. And here's their news flow for refining and chemicals. So marketing and services, and that's mainly really their gas station. What I found very interesting on their latest investment call they did was they explained how they're not really so interested in their retail and their service stations because in the future, people don't really charge their EVs in gas stations. They tend to charge them when they're at home or then when they're at work. So they're actually pivoting away from the service station, which is actually quite different to, for example, BP's strategy. TotalEnergies is saying, no, we're not Tesco's. No, we're not going to be like running this little mini supermarkets as part of our business. And they're kind of outsourcing that, which is kind of, really interesting. And they will have a EV charging network, but it's going to be where people need it, which is actually on motorways. Here's a breakdown of their sales of petroleum products. And this is where their service stations are. So they're winding back, they're winding back a bit in Europe, and actually most of their ones are just in France. But actually they have a lot in Africa and a lot in Asia, particularly I think India. And that's actually good because in those places, people aren't going to be moving to EVs so fast. So they've still got so they've still got a marketing business, but it's more focused where the money is, and they're not trying to turn themselves into a Tesco in Europe, unlike BP. Here's where their charging points are, and here's their news. And the most important one for me is where they've actually divested 2,000 service stations in Belgium, Luxembourg, and Germany. Exactly what I've just been talking about, where actually they're selling them to a supermarket called Couche-Tard. So they're going to take them over effectively as mini supermarkets, which also sell petrol. And as part of that deal, it will be TotalEnergies petrol that they sell. I'm generally, by the way, very impressed with the management of this company. And I do find that they box clever. There's a lot of common sense in a lot of the things they do. And this is a very good example of that. So moving across to the numbers, and remember that these are Q3 numbers, so you've got to add another 25% on top. Given that our reference really is the oil prices, because 2022 was a bonanza year. So really, we want to compare with 2021, and the oil prices have, remained at those new normal levels of 2021. And when we compare to 2021, these look like very healthy numbers. The sales are nice, and the net income is looking very, very good compared to 2021. So they do seem to have achieved a seismic shift upwards when you compare the business to the pre-COVID years. It now seems to be long term in a higher gear, looking very good. And that, of course, matches entirely with what we see with the data, which matches with their strategy of being the number one importer of LNG into Europe and running power stations, gas power stations in Europe, and running refineries mostly in Europe. The perfect strategy for the energy policies of the European governments. For me, TotalEnergies really are in prime position, pole position versus the other oil majors. You see it in the data here, and you see it in the numbers. Beautiful, beautiful numbers. We see that reiterated with their net income history. Bear in mind these are Q3 as well. There's a lovely gap forming between their income and their expenditure when we look at their net income history. And when we look at their net income by business segment, we see that exactly as you'd expect from those trends, they're doing really well in the integrated gas, and they're also doing really well in their refining. And with oil prices at relatively historic highs, doing very well with their exploration production as well. Looking at their assets, and the actual general signature hasn't changed. If you go and look at my previous video, I go into the ins and outs of each of these line items in quite a bit of detail, but I won't bother doing that for this video. But the main point really is the majority of their long-term assets, so is their property, plant and equipment. And really the current assets make up a third least of their overall assets. And these are all very healthy things, inventories, accounts receivables, and cash that's currently sitting at 25 billion. Their short-term liabilities seem quite large, actually, at 94 billion, but they're displaced by the current assets, and I think it's actually just part and parcel. I think this is just part and parcel of an oil business. They tend to carry large short-term liabilities just as a function of running a business. It's 37 billion accrued liabilities and 37 billion account payables. I just think that's what it's like being a supplier to an oil company, and that's just how they roll. So I've got here their assets tabulated, and you can see there's all those, really good quality assets in terms of their current assets and their cash, which then kind of is there ready to pay the rather large short-term liabilities of 110 billion. So those kind of cancel out. In terms of their long-term liabilities, really, there's not very much. They've not actually got very much in terms of long-term liabilities, and it's mostly the most significant thing being actually the debt. And of course, I don't like them having even 41 billion of debt. I generally don't like debt, but actually, when you compare it with the general swill of short-term assets against their long-term assets, actually that debt is actually probably fairly low for an oil company. and then they have other of 44 billion. So here I've got their overall 189 billion of liabilities, and then you match that against their assets, most of which are, fairly much very high quality assets, and you see here that differential, which will be their net assets. And then when I line up their net assets against their market cap, they have a price to book valuation of 1.2. So in terms of just their price to book, they do look reasonably valued, I'd say. And there's not really anything untoward here. So here I've got the graphic I do, where you can see their net assets against their market cap, and they're not in any way looking overvalued here. And of course, this gives them their price to book of 1.2. And this is a healthy net assets. Look at, the debts going down, and look at how big a proportion the cash is, and look how nice and chunky their net income is looking versus their market cap compared with historically. So this is in its own right a quite a healthy profile. But then remember that for an oil company, the actual oil in the ground isn't included in their net assets. The oil in the ground is calculated as their discounted future net cash flows, which I tabulated here. And so what that tells us is that at $70 oil, that's just under, about 90 billion or whatever quid. So you put that on top of their net assets, which we know are fairly quality, and then you see, they look very reasonably priced. Now, it's interesting as well, taking it the other extreme. They're not mega cheap. I mean, at $101 oil, add that on top. You wouldn't really rationally expect this company to 5x from here, not at all. You probably wouldn't really expect it to 2x, if I'm totally honest, at $100 oil. So, this is very interesting exercise. Now, bear in mind, this is just the oil in the ground, and let's assume $70 oil. That's just the oil in the ground. You've also got to think the other aspects of their business, like what about the future cash flows from their gas power stations? What about their LNG sales? Is that counted here? I don't know. But in terms of just the oil and gas they've got in the ground, they're nicely priced, but don't go buying into them expecting it to five bag. In terms of their statement of cash flows, they achieved 25 billion from operating activities, and they gained 2.2 billion from disposals. Then they had to pay 12.6 billion on capex, 5.9 billion on dividends, and they decided to pay off 4.8 billions of debt. They invested 5.4 billion of inorganic growth, including those pesky renewables investments, and they decided to award shareholders with a 5.8 billion of share buybacks. So when I take away the stuff they don't have to do, we see that if they were to take their income from normal operating activities, do the capex spend they have to do, and do the 5.9 billion of dividends they have to do, they would still be left with 6 billion of cash free. So, they are in a fairly healthy situation here. They do definitely have a very healthy cash flow situation. If I was to be critical, and bearing in mind the money that they are spending on the renewables, that extra 6 billion of cash, if you were to use that on the inorganic growth, which they kind of have to do for their current strategy, then they're still 1 billion in the plus after paying off all those dividends, but they're not necessarily in a situation where they can pay off debt and do the share buybacks. So I think I'll have another think about this when their full year comes out. But really, fundamentally, they have got a fairly healthy free cash flow. In terms of their shareholders, and only BlackRock have enough shares to show up on the radar. And you certainly need to have to own a lot of shares to get on the radar of this company. But they are BlackRock have been only buying the last few years. And what's interesting is they do have a lot of retail investors and a lot of employees own shares in this company, which is a good thing, and it's an unusual thing and also a good thing. So they have a kind of interesting, maybe slightly quirky shareholder breakdown, but there's no kind of no particular trends I can pick out. And in terms of the oil sector, it's actually the oil, gas, and coal sector. To be honest, I did draw this long-term trend line, and they look in danger of having broken that trend here. Now, when I go into the longer term trend, they do tend to, there's like a longer term trend, and they're here, and they're, are they breaking it? Is there like could you perhaps call this a long trend where whenever there's a big when there's a economic disaster, the sector crashes out of it, and maybe they're back in this, maybe. But really, if I'm honest, I drew these trend lines a long time ago, and if you were going just on the sector trend, you would say now's a good time to sell, if I'm totally honest. And I am a little bit anxious about this. So, in summary, TotalEnergies have had a strategy that they put in place way back in 2017. And whilst all the other oil majors in Europe have been flapping around, chopping and changing, TotalEnergies have really stuck to their guns, and I really do respect them for sticking to their guns. You have to accept that a third of their new investment is going into renewables, and you just have to live with that if you are a shareholder in TotalEnergies. But the fact is that they're the number one exporter of gas from the US, where gas is the cheapest, and they're the number one importer of LNG into Europe, where gas is the most expensive. The price of electricity in Europe is through the roof, and that's where they have gas powered power stations. And they've maintained their oil and gas and oil prices are equilibrating at a much higher level than they were historically. So, really, for me, TotalEnergies really stand out from Shell or BP as being in the best position for making money out of the energy policies of the European governments. And here you see the data, they are in rude health. Really, the main caution for me is what's going on with the oil and gas sector, and then also the macro situation generally is a concern. For me, though, I bought TotalEnergies back here. I mean, actually, I bought BP in June of 21, and I sold the BP and then immediately bought TotalEnergies instead because I didn't like how much of BP's reserves were based in Russia. And so, really, my oil bet began here, but let's say even my all began here. I've got the luxury here of, you know, I've put in place a 20% stop loss. I can live to that, and I've still made money when I sell. I'm getting a really nice 7% dividend yield on my total energy investment. So also in light that my portfolio overall is very defensive and is only even 18% stocks anyway, it makes sense for me to hang on for the dividend yields. I think there's a nice kind of channel here, perhaps. And so I'm only going to start getting skittish when this gets violated. Otherwise, I'm quite happy to try and hold on to my TotalEnergies in the long term for the really nice 7% dividend yield I'm getting. So here I've summarized why I'm holding on to my TotalEnergies. Please remember to speak to your investment advisor though before making any investment decision. Don't just rely on people's YouTube channels for that. But I do these videos because it helps me get a good grip of my own investments, and I actually enjoy doing these videos. So I hope you enjoyed this video for entertainment purposes only, and good luck with your own investments. Please read the disclaimer. Remember that prices can go down as well as up.